Cheesecake Factory, number 2 of these 5 stocks that just reported earnings. So Cheesecake Factory, another stock I've been buying very heavily. I own the stock in the public account. These are the shares I'm showing you here. I think I own these in private accounts. I own these in my dividend account. I've been buying this stock, excuse me, very heavily the past few months, okay? This is one I'm trying to add aggressively as well. Also down after hours, very slightly. This one I think is probably going green tomorrow. Outside of a scenario where the market's down huge, I think it's probably going green. The earnings are phenomenal. I'm still going to have to listen to a conference call tonight, but these earnings of these 5 stocks, you know, it's a real debate if this was the best earnings or if PayPal was the best earnings, but these numbers are phenomenal. Okay, let's just call it what it is. Revenues grew very nicely on a year-over-year basis. They grew revenues a little over $30 million on a year-over-year basis here. As far as food and beverage costs, that went down for the company, went down by 1.3 percentage points, or a fancy term, 130 basis points. If we look at labor expense, man, a lot of companies' labor expense is actually climbing right now. Labor expense for Cheesecake Factory actually went down on a year-over-year basis. That's good. Other operating costs and expenses went down in terms of the percent of revenue, right? General administrative went up a little bit as a percent of revenue. That's why I have it blue there. Income from operations went up substantially as a percent of revenue. That's phenomenal news. Up to 5.5% of revenue made its way down to income from operations. That's versus 3.4% at this time last year. That's insane, okay? That's absolutely insane. We're talking about 210 basis points of growth from income from operations. That's not a number you usually see from companies, okay? Not usually a number you see. That's phenomenal. Net income to 4.9%. They almost are at 5% of revenue reaching all the way down the bottom line, which is a great number for a restaurant. If you can talk about hitting that 5 to 7% number in terms of, you know, how much of your revenue reaches down to your bottom line is for a restaurant, that's freaking amazing, okay? And so I think it's a possibility that Cheesecake could get to those sorts of numbers at the end of this year. Now, at this time last year, that was 3.1%, right? So huge, huge uptick in the business overall in terms of how they're running this business, right? Now, this is extremely important right here, okay? The company has total available liquidity of $330 million, including a cash balance of $91 million and availability on its revolving credit facility of $238 million, right? So clearly the company can keep building out restaurants, which, you know, they still have a lot of opportunities for growth here. The company also repurchased 280,000 shares of its stock at a cost of $9.3 million in the second quarter. In addition, the company is, you know, going to pay out another 27 cents per share you own of Cheesecake Factory on August 29th, 2023. I'll take that money. Thank you very much. I'll go ahead and probably buy some more Cheesecake shares with that money overall. Okay. Now, if we look at the breakdown per restaurant, Cheesecake Factory grew about $12 million on a year-over-year basis in terms of revenues. North Italia, which is its phenomenal growth engine, that's the business I'm most excited about that Cheesecake Factory owns. They grew revenues nearly $10 million on a year-over-year basis. On a percentage basis, run the numbers on that. It's incredible. Other FRC, which is their other concepts, $65 million versus $60 million. So they grew that about $5-6 million on a year-over-year basis. And Other grew very nicely as well. Income from operations. A huge uptick for Cheesecake Factory restaurants. Very nice uptick for North Italia. Other FRC was a little bit of a holdback there, and obviously income from operations up substantially year over year. So the company is basically getting to far more profitability now at this point in time than versus where they were at last year, which is not a surprise to me. This is what I called out several times when I talk about Cheesecake Factory. I said their margins are about to expand quite dramatically, and their profitability is going to expand quite dramatically. They had to go through, obviously, ridiculous inflation that on the wage side, on the product side, just last year was a complete disaster if you run a restaurant. And now all that's going away, and so what ends up emerging for Cheesecake Factory is a company that's going to be far more profitable, and margins going to be far better for this one overall. So Cheesecake Factory, love this one. Easy buy the dip opportunity if it even dips, which once again, I'm not even so convinced it's going to even dip tomorrow. We'll see, okay? Now, Fubo. What happened here today with Fubo? Something extremely interesting happened here today with Fubo, okay? So Fubo's up 164% in the past 3 months. 3 months, 164%. Today was the day Fubo stock should have dropped big, okay? The stock right from basically the open of the market, it just dropped. And it bottomed. And then the stock, as the trading day went along, it just got stronger and stronger and stronger and stronger. This was the day the stock should have dropped big. I don't know if somebody knows something or somebody's just very hopeful on numbers. I don't know what's going on with Fubo, but it's acting strange, okay? Even prior to this, the moves were ridiculous past few months in regards to Fubo. Up, huge, down, huge, up, huge, down, huge. But I see something like this and I'm like, I don't know, man. With earnings coming this week, either somebody's just taking a big gamble or somebody knows something. I was only down about $14,000 or so in the public count here today. That's pretty fortunate. This was one of those days that could have been like a $50,000 down day, a $100,000 down day. And to only be down 14,000 or so, I'll take it. I'll gladly take it because this was one of those days. But at the end of the day, like when it comes to that portfolio, it's a $1.8 million plus portfolio, right? But a lot rides on these two stocks, Meta and Tesla. And so if those two stocks hold up, they really hold the whole portfolio. On the flip side, if they go down, they hurt the whole portfolio in a substantial way, right? And so that portfolio is really driven by these two stocks. And it's not because I put in so much to these stocks. It's because they've gone up so much, right? Tesla, we've about 1,000x our money on, right? Or 1,000x, made about 1,000% on our money on, right? And then Meta is up, $300,000 plus in this account. So these positions just got so big over time. It wasn't like I, planned to build them that big. And, I look at a stock like Revolve. Even Revolve today, they reported dumpster fire of a quarter. And, the stock only went down 5%. But the question you got to ask yourself, how does a stock like Revolve report a dumpster fire of a quarter, and it only goes down 5% here today, okay? I'll tell you exactly how. When you are beaten down dog stock, and, everybody that pretty much wanted to sell a stock has already sold that stock, that's how a company like Revolve reported net income down 50% plus year over year, revenues that went down for a company that usually is a double-digit grower. And also everybody's looking at the future and they're saying Revolve has much brighter days ahead. Then obviously this past quarter, the business is troughed and now things get better. That's the belief, at least out there, which is why that stock was only down 5% on a dumpster fire quarter. I mean, if that was a high-flying stock, that stock would have been down 30-40% today, but it's not, right? The dividend-only portfolio, where I only have dividend stocks, the account was about break-even today. This is a win. Like today, on a day like today, this was a win for me. It was down $5 here today on a $177,000 portfolio, and that was after Qualcomm, which is a dividend stock I hold in that portfolio. They reported a dumpster fire quarter. Really, really bad numbers out of Qualcomm. I don't know if you guys got to see that report. I went over the report. In yesterday's video, the numbers were bad, man. But the dividend portfolio is really driven by these four stocks here: Nordstrom, Tapestry, Wynn, and Foot Locker. And so that portfolio really goes up and down based upon these stocks, and those stocks did pretty decent today, okay? Now, a friend sent me this, and I thought this was really, really valuable to everybody out there, is now all the big dog companies have reported earnings, okay? So now here's a look at the big dog companies and kind of what their revenue growth is looking at year over year, right? So first off, the three biggest positions I have in the public account are all the companies that are growing fastest in the world right now in terms of big tech companies, which I'm very, very thrilled about, right? Tesla's 47% growth this past quarter, and that's incredible considering the interest rate environment we're in right now. Meta, 11% growth. Amazon, 11% growth. We'll dive deep into the Amazon numbers in just a moment. I got some really interesting things to show you guys. Microsoft, 8% growth. Google, McDougal, 7% growth. If we look at Netflix, 3% growth. Apple's actually shrinking their business. And if I recall, they had an extra week in this past quarter, if I think so. So their numbers could have been worse than that, but nonetheless, Apple's revenues are going down, and then AMD had kind of the really disappointing. The one big dog actually left to report of big tech land, NVIDIA. That's the only guy we haven't gotten yet.